Hey folks, Shawn Plummer over at the Annuity Expert. In today's video, we're going to be answering the question, is a fixed index annuity a good investment? We're just going to really tell you the good, the bad, and the ugly, where it's great, where it's not great, what you give up, and some red flags when you're looking at a fixed index annuity. Just kind of give you a little overview before I go into the fixed index annuity. There's three main types of deferred annuities. There's your fixed annuities or your MYGAs. And MYGAs are basically like a CD where you have a fixed term earning a fixed interest rate for that set fixed term. Okay. Then there's on the opposite end of the risk spectrum is the variable annuity. And the variable annuity is you're using like mutual funds. You're actually in the market. You can lose money. And then if that MYGA and that variable annuity had a baby, that would be the fixed index annuity, where a fixed index annuity will give you the choice of a fixed interest rate that changes on an annual basis based on the interest rate environment, or you can earn interest based on the performance of a stock market index like the S&P 500, NASDAQ 100, Dow Jones, without actually being in the market. You have 100% principal protection from a stock market crash. So that's what makes it fixed, and that's what makes it indexed. Okay. The folks who like a fixed index annuity in terms of growth are folks looking for bond alternative, folks who are near or in retirement and don't want the hassle of losing money. With the fixed index annuity, most folks say that you're capped on the upside. You can't really earn that much. And the reality is that that's not true. I mean, in my wife's fixed index annuity, she's earned almost 24% in between 2020 and 2021. And she locked in those gains. She paid no fees. And she was able to continue to grow on top of that interest that she earned. So if you're getting north of 10%, which doesn't happen all the time, so just keep that in mind. And we'll talk about good, bad, and the ugly in terms of growth for a fixed index annuity. It's just, if somebody says, oh, I'm going to poo-poo on a fixed index annuity, it's not a good investment, well, they're probably full of poo-poo. So with the fixed index annuity, yes, what you give up is you give up all the upside, right? So if you're comparing the true S&P 500 being in the market to a fixed index annuity in the S&P 500, you're comparing apples and oranges, okay? You're going to get a good chunk. You should expect, if you have a decent annuity over the entirety of the contract term, you should expect anywhere from a 4 to 7, maybe 8% rate of return. And then all the interest that you earn is locked in, so there's no ups and downs of the market. Basically, what the insurance company does is they use the index as a measuring stick. So just have the picture of a ruler or a tape measure in your head, and they just look at the performance of that index between two different dates. So the date that you start the index strategy, and the second day, the end of that reset period. So whether it's a year or 2 years, sometimes it's 5 years. And they just look at the difference between the two individual dates, right? And if there's a positive growth from the end index date or the reset period or anniversary date, whatever word you want to use, then they apply some sort of interest to your account. I'll tell you what, when I look in terms of growth and I'm looking for a fixed index annuity, I stick with the KISS method. Keep it simple, stupid. I typically choose fixed index annuities that have indexes that you can see on the news every day. You turn on the 6:30 or 7 o'clock news, it tells you if the S&P is up or the NASDAQ's up or the Dow Jones is up. Stick to that. A flaw in our industry in my opinion, is that a lot of these actuaries and insurance companies are trying to get clever with the different indexes you can choose. And my opinion, not a fact, they're setting their clients up more for failure than for success. Okay. They're using mutated versions, but they use the word engineered versions of the S&P 500 or Dow Jones or the NASDAQ. I say, hey, I'm looking at the S&P 500, I'm looking at the Dow Jones Industrial Average, maybe the Dow Jones Real Estate, and I'm looking at the NASDAQ 100. Okay, that's it. If I'm going to venture out of those three indexes when I look at a fixed index annuity, I'll look at maybe sometimes you have gold as a commodity. I know certain companies are now allowing you to earn interest based on the rise of AI, or Bitcoin is a new thing. If you want to go into those worlds, great. But if you're just the ordinary safe investor that wants a fixed index annuity, S&P 500, NASDAQ 100, Dow Jones Industrial Average, and you should be good. Okay. And the good news is you can in some years that you think are volatile or aren't going to return anything, you can always move over to the fixed account and get a fixed interest rate for that year. I've seen that be as high as 8%. I know of an annuity this year that if you bought a fixed index annuity, their fixed bucket for year one is 8%. So there's an interest rate there that you can earn if you don't like the index performance. Okay. Moving on. Why else is a fixed index annuity a good investment? They have the best income riders out there. They're better than variable annuities. They're better than any MYGAs that have an income rider. They have better bells and whistles at a cheaper cost. You're going to average around 1.25% in fees that come out of the contract. Where variable annuities, you're going to pay 3 to 4% in fees, which I think is way too much to pay for. You might as well be in the market at that point. Here in 2026, MYGAs are guaranteeing 5 to 6% for a fixed period of time. It's a hard sell between earning 5 and 6% in a volatile market as opposed to like gambling and trying to make, index returns while the market's doing what it is doing as of April 2026. Okay. But it's good. Where it will shine, I think, with fixed index annuities in terms of growth is when everybody loses their rear in the market, like 2008, 2009. They all had to wait and catch up to get back to their previous high point. I think that took like 3 or 4 years, maybe longer, to get back to where they originally were prior to the Great Recession. And with a fixed index annuity, you just don't have to worry about that. If there's a bad year, nothing happens to your account. You just don't earn any interest that year. But at the same token, you don't lose any money. So, and then the other cool thing about fixed index annuities that I think are great as a good investment, especially in volatile markets, is because you're not actually in the market and the insurance company is looking at 2 different dates and time, you're able, in a down market, so a bear market, you're able to earn interest while it climbs back up and stabilizes, right? So, for example, if you would have bought an annuity in 2008, and around October, November, the S&P starts to go down, well, everyone's losing money. Like, we know that. But if you had a fixed index annuity, you just wouldn't earn interest that year, and you would have preserved your principal. And then in like April 2009, when it will like hit rock bottom, from that point on, it going back up, you're earning interest. You're like, there's no catch up. You are growing your account in that down market because we're looking at 2 different dates, right? So we'll kind of go over that briefly. So if you opened up a fixed index annuity today, April 8th, 2026 is when I'm recording this. At the end of today with the S&P 500, the insurance company is going to take a timestamp of what the value of the S&P 500 was. And then they're just going to not do anything until April 8th, 2027. And they're going to look at the value of the S&P 500 when it closes on that day, or the nearest business day if it falls on a weekend. And if the value of the S&P 500 is higher than the S&P 500 today, well, you're going to get some sort of interest, right? Depending on what the cap rate is or the participation rate is. It's going to be a positive return for you. And because you're in a down market, you're able to, as it's climbing back up, you're able to earn interest along the way, which I think is so cool, okay? Some myths about fixed index annuities is you're capped on all your upside. That's not true. Yeah, there are cap rates out there, but a lot of the annuities, they don't have caps. They have participation rates. And to kind of go over the different limitations on your upside potential, a cap rate is a ceiling, right? So if you have a 10% cap on your fixed index annuity and the S&P 500 returns 15, you're only getting 10 of the 15, right? So you have a cap there. If you have a 50% participation rate and no cap, the S&P 500 returns 30% growth in 1 year, well, you're getting 15 of that, right? You're getting 50% of it. Okay, so there are fixed index annuities that do pretty well. It's just really not for the person who's looking to like be a control freak. That's another thing. You got to be able to just let the insurance company do its thing. And somebody who's not wanting all the upside. You know, if you're a day trader, you know, fixed index annuity might not be a good fit for you. But even though I think as a bond alternative, I think it's a good solution to look at. What else? Fixed index annuities, if you look at the annuity world, provide the highest income payout percentages as of April 2026. So if you're looking for the highest lifetime income with annuities, you go right to the fixed index annuity. They've got some of the best bells and whistles, like for long-term care. Increasing income, I think, is great. You're able to get lifetime income with the ability to increase either by a fixed interest rate or the CPI, which is a tool that dictates inflation, or the index performance can increase your paychecks in retirement. And once you get an increase in your income payment in any given year, the income can never go backwards. It stays. That's the new floor that it can pay. So I think that's great. There's bonuses with fixed index annuities, but I would be cautious about that. They're great if you're trying to offset loss. But with any annuity, the analogy I use is that there's only 100 pennies in a dollar. How are the actuaries allocating those pennies? And a lot of times if you buy a bonus annuity and there's some other guaranteed income rider or guaranteed benefit there, you're probably going to give up on the upside potential, right? So it's critical to deal with an annuity broker, because that's really their specialty. You know, you go to a bank or a credit union, you are highly likely to be buying a piss poor annuity product. I just spoke to a lady yesterday who bought in 2018 a SILAC annuity, and that's one of the worst rated insurance companies in the United States for annuities. And I was just shocked somebody at a bank or a credit union sold her that. We represent over 1,500 annuity contracts. We have the largest selection of annuities in the United States. There is zero reason to get a piss poor annuity, right? So just know that. Just know that, hey, if you're going to gain something like a bonus, when I used to work for Allianz, one of the things they said is the more guarantees you put into an annuity contract, the more you're going to give up elsewhere. So if you're getting a premium bonus and it's a 20% premium bonus and they have an income rider option, expect that income rider not to be fantastic compared to everything else, right? Or the upside's not as great. You're going to have piss poor upside potential, but you're going to have this guaranteed bonus that you're going to get. Or, you know, you may get the highest income out of all the insurance companies, like by far in terms of comparison. but the upside may not be great. And the reason is that annuity is not designed for upside. It's designed to give you the most income possible for your situation. So I think fixed index annuities, all in all, those are my favorite out of all the out of all the annuity types: MYGAs, fixed index annuities, and variable annuities, simply because there's so much flexibility in terms of bells and whistles that you can add and design for your particular retirement scenario. And it's a fraction of the cost of what you would pay for a variable annuity, which most financial advisors sell to you, which I think is just too much money for what you get. Okay. So let's just talk about the cons. You're not going to get all the upside in the world, right? You're going to average 4, 5, 6, 7% a year spread out over the contract. So one year you might get over 10% in returns and interest. And the next year you might get 3, and the next year you might get 5, and the next year you might get 8, but if you average that all together, 4 to 7% is kind of the sweet spot. I think another con is a lot of the fixed index annuity companies are offering these mutated engineer indexes with these astronomical returns. I think a lot of times that's a crock of shit, and you should be very skeptical. And speaking of illustrations, if you look at an illustration and you see like 10% plus returns because they're illustrating historical returns, it's of the last like 10 to 20, maybe 25 years. Well, that's one of the biggest runs in the stock market, in American stock market history. We've had a fantastic run. You think you're going to duplicate that going forward? Probably not. So don't let somebody sell you on like the world with a fixed index annuity. My guess, not a fact, but my guess is that whatever illustration that you're shown, expect to do half of that, simply because we're involved with several wars. Unemployment is increasing right now. I still don't think we're paying the price for COVID, and I think the economy is just volatile, and so I don't think you're going to go on this awesome tear where you're going to earn what those illustrations offer you. So the compromise, I say, is stick with the S&P 500, stick with the Dow Jones, stick with the NASDAQ. At least there's some sort of consistency. And if they're not doing hot over a long period of time, everybody else is highly likely to be doing awful, right? And then at that point in time, everyone's losing money, but you're not, because you're in a fixed index annuity. And you don't lose money to a stock market crash, right? So where else does it stink? You got to pay a fee, but you get what you pay for. With a fixed index annuity, you get an income rider, you're going to pay 1% fees, 1.25% fee. Well, you're paying to get more income. Overall, it's cheaper than having a financial advisor manage your money. Which, let's get to that. If I see I see on YouTube these YouTubers that talk about annuities like they know what they talk about, and let me tell you, I would say almost all of them are full of shit. They don't know how it works. They don't know about the fees, and they use fear tactics when it comes to fixed index annuities. I'll give you an example. There's a couple of stupid knuckleheads out in Tennessee that act like they know how annuities work, and they're almost categorically wrong on how it works. They even come up with a fictitious return map. They don't talk about the benefits. I think if there's anything that you get from this video, it's like there are pros and cons to everything. And like any product out there, commodity out there, it evolves over time. And I think we are at fixed index annuity peak. I think now a fixed index annuity for a lot of problems can do a better job than paying some financial advisor a fee every year to manage your money for the next 5 to 10 years. I think you're going to get more income. I think it's going to be a stable income. I think it's going to be at a cheaper price. You're not going to get as much upside, but you're not going to lose as much money. Okay. And I think these overly confident turds that are on YouTube talking about how annuities work are going to get burned in the next couple of years. And we have permanent recording of the piss poor, bad, fear-invoked advice about annuities, and I think they're going to pay the price for it. I think their securities license, they have to do what's in the best. They're fiduciaries. Invoking fear into people is not fulfilling your fiduciary duty. So anyway, sorry for that rant. Going back to the negatives of fixed index annuities, I think if you're in retirement and you're not ultra wealthy, I think a fixed index annuity can solve a lot of your problems. And I think they can do a better job than handing over a large chunk of money over to a financial advisor at any of your big box financial advisory firms and then managing your money. Let me give you an example of that. Got a couple out of Minnesota. They're getting out of their variable annuity and at one of the big box retailers. And that person said, hey, they're like, hey, we can take it out of this variable annuity, we can manage it, and we can confidently get you around 6% using this mixture of investments. And I said, okay, so he's saying that he's going to give you 6%. Like, well, is that before his fee or after his fee? Okay, because you want to find that out. And then at the same token, you're still exposed to losing money on his portfolio. Why wouldn't you just go into a MYGA and get 6% a year for the next 5 years and then put yourself back in the market when the market stabilizes? And hopefully these wars are put in the past. And the couple asked that person, that representative at that big box advisory firm, and he said, oh, well, I don't know. I don't know why I did that. Well, I'll tell you why. It's because they don't make hardly any money off of a MYGA. So going into the commissions, let's talk about commissions and fees. If you're going to invest with somebody for 10 years, if you buy a MYGA, somebody's selling you a MYGA, a multi-year guaranteed annuity. It's the CD annuity. You're going to earn 2 to 3% on a 2 to 3% commission on whatever the amount of the annuity is. So if you've got $100,000, that person's going to earn $2,000 to $3,000. Okay. If you had somebody charging a conservative 1% management fee at one of your advisory firms, well, over a 10-year period, that's assuming that there's no, your same $100,000 stayed flat or negative, that's $10,000 out of your pocket. So $2,000 last time I checked is a lot cheaper than $10,000. Now we'll go into the fixed index annuity. Fixed index annuity is going to give you a 7 to 9, maybe 10% payout for the rest of your life. You go to a money manager, they're going to give you a 4% withdrawal rate, and then they're going to increase it for inflation. And they're going to charge you 1% a year. Well, an average commission for a fixed index annuity is between 5% and 7%. So it's on $100,000, that's $5,000 to $7,000. A financial advisor charges you 1% management fee, which is usually higher than that. So I'm being conservative when I say that. That is $10,000, still more expensive. Here's the difference between the two. You earn a commission on a fixed index annuity, doesn't affect your annuity contract positively or negatively. And that comes from the insurance company to the annuity broker. But you pay a financial advisor, if it's a good market, man, you're happy to pay that 1% management fee. But if the market crashes, in most cases, you're still paying that 1% fee. If you ever watched that movie, This Is 40, the wife goes to their financial advisor, and the financial advisor says, hey, the financial advisor was telling the wife that her husband had spent all their money investing in this music industry business that he wanted to go into. And then he makes a comment, hey, I'm here if you need any kind of help. And the wife says, well, how can you help me get my money back? Oh, there's nothing I can do there. And that's what you're going to run into. That's what you're going to run into. Market tanks, they're not going to be able to do anything, and they're going to continue to charge you that fee. So that's the main difference. It's such a head fake, and it's used as a marketing ploy. And frankly, hopefully there's some legislature in the future that makes that a strike against fulfilling a fiduciary duty. Fear tactics. Fear tactics should not be in any sort of conversation about any kind of product that person can't sell or won't sell or not educated enough to sell. Annuities has hit a record high sales. It's one of the highest selling financial products in the United States as of 2025. The reason why is because it does a better job for a lot, not all, but a lot of things that a financial advisor can do. It can distribute money better. It can keep up with inflation better. It's at a fraction of the cost. It can protect your principal. What it can do, it can't give you all the upside. If we had a duplicate of 2012 to 2024, 2025, an annuity, specifically a fixed index annuity, not even close. You might be able to do half. That's what I would guess. So, can you double your money in a 10-year period with a fixed index annuity? Yeah, but it'd be extremely difficult. Can you grow it by 50%? Yeah, that's doable. Can you grow it by 75%? Yeah, that's doable. Can you double it in 10 years? Probably not. Probably not. But you're not buying a fixed index annuity to get all the upside in the world. You're buying the fixed index annuity for protection. You're buying it for long-term care help. You're buying it for lifetime income, more income than having somebody manage it. You're using it to get an above than average rate of return. You're looking for predictability. That's the big thing. If you're looking for just consistency, predictability, and you don't have to worry about it, that's where a fixed index annuity works. Where it doesn't work is like, hey, I want to roll the dice and I want to get as much upside as possible. Just that's what you're giving up. So let's see if there's any questions here that my clients have asked. What's the difference between an equity index and a fixed index annuity? They're basically the same thing. I think they changed the names in the 2000s because it offers a fixed interest rate. And I think before that they would only allow the equity indexes available. Can you do all different types of indices for fixed index annuity? Yeah, I think there's like 100 plus options you can choose from in terms of how you earn interest. So like I said earlier, AI, Bitcoin, S&P, Dow Jones, NASDAQ, there's volatility indexes, there's bond indexes, there's Barclays, there's PIMCO, Russell 2000, there's international, you can do gold and commodities. I mean, you can do all kinds of different indexes. So that's there. Some folks say it's a complex product. It's really not. If somebody says fixed index annuities are terrible because they're complex, that person is stupid. That's the best word for them. That person is stupid. That person is not willing to take the time to educate you on that because they're either stupid or it's a bait and switch. It's not that complicated. And they assume that you're stupid. Let's see, death benefits, you avoid probate in most states, lump sum death benefit. Usually get 10% penalty-free withdrawals. You don't lose money, you earn interest, and you have a lifetime income if you choose to. So I know this is kind of a long-winded video, but all this is off the cuff, and this is my professional opinion of 18 years of doing this. I hope this answered your question. If you have questions or you want an apples to oranges or apples to apples comparison, I'd be more than happy to do that for you. It's free, no obligation. And check us out. Go to your favorite search engine, Google, Bing, Yahoo, type in the Annuity Expert. We'll show up. You can also call us at 770-755-1565. Hope all is well, and we'll catch you on the like and subscribe too. That helps me get in front of more people. Also, leave a comment. Comment. Give me your harshest opinion on annuities. But if you're going to leave a comment, for Pete's sake, can you just be very specific on the annuity? Okay? Don't say fixed index annuities are a scam or fixed index annuities are garbage. That's not helpful to other people. Tell me why it's garbage or why it's crap, and at least give me the opportunity to combat it. Okay. So once again, thanks for the call, or excuse me, thanks for the video, and we'll catch you on the next video. See ya.